Good morning dear learners and welcome to you all in the next module of my course on financial literacy. This is module number 7, investment avenues, and lecture number 32, insurance and related products. I, Dr. Vandana Sonkar, Assistant Professor, Faculty of Commerce, welcome you all to this particular lecture. In this lecture, we will be going to discuss the concept and nature of insurance product. We will be going to talk about the various types of benefits that insurance product offer to the different investors in the market. We will be going to understand the different categories of the insurance product under the life insurance schemes, its principle and its types, as well as we will be going to understand the differences between the term life insurance and the permanent life insurance schemes. So, their key features and eligibilities that an investor must have for investing into these insurance schemes will be discussed under this lecture. So, in this particular module, we will be going to understand how the insurance product can also help you to attain your long-term financial objective of accumulating the wealth over a period of time and mitigating the different type of financial risk associated with your life. So, let us start the first concept, that is the insurance. Insurance is basically a tool that is used by an investor to minimize the risk of financial losses in any type of activity or in the life. Basically, it is a mechanism that helps you by minimizing the risk that may be associated with your economic decision. So, it is a mechanism in which the group of individual agrees to share the burden of loss of the financial investment whenever it occurs for any particular group member. So, basically the loss is covered must be financial in nature, not emotional, for to be covered or included into the insurance product. So, a more formal or a more contractual definition if we talk about of the insurance, then it can be discussed as a contract between the insurer and the insured. That means insurer is a person who provides the insurance facility to the consumer, whereas insured is the person who wants to avail the facility of insurance by any company. The contract between the insurer and the insured, in which the insurer agrees to compensate for a specified loss or to protect the insured from such losses in exchange for a premium. That means in case of the insurance product, we are offered by the insurance company a financial instrument that can help us to recover our financial damages involved in our financial decision making or in our life. However, it is compulsory that the loss must be of economic nature, that means financial in nature. No emotional or the loss related with the life can be compensated to 100%. Only the damages related with the financial loss can be managed and covered with the help of the insurance product. So, the principles, underlying principle of the insurance are basically principle of cooperation and principle of probability. So, these two principles helps the insurance scheme to design multiple category of insurance product for the consumers in the market. Principle of cooperation basically means, or you can say it is a kind of principle that works on a principle of cooperation. That means a cooperative mechanism where a group of individual is selected and the investment in the form of premium are asked by all of them to cover the financial damage occurred to any particular group member of the group. So, principle of cooperation helps you to minimize the risk of the every group member who have contributed their money into the scheme for the purpose of mitigation of risk, whereas principle of probability says that there may be various chances of occurrence of the financial damages, or there may be probability that the damage may occur, and on the basis of that the claims can be recovered for the insured. So, insurance facility basically gives us a risk management tool with the help of which we can minimize our different types of risk, such as the risk related with the life, the risk related with the fire, or any other kind of loss by theft, by natural events can be covered. The financial damage can be compensated with the help of the insurance products. Now, let us see what different advantages the insurance products provide to us. It provides us security, that means a sense of financial security can be very easily achieved with the help of the insurance product, and it also gives us a sense of security. Security and financial safety can be gained with the help of the insurance products. It gives us protection to our family. So, financial protection is also offered by the insurance product to our family members. So, in case of our death or in case of physical illness, the financial protection can be offered by the insurance products to our family member. It also provides us help in the achievement of our long term objectives, such as for the purpose of our child's education, or for the purpose of building a house. We can take the help of the insurance scheme. It helps us to boost our confidence. If we will be financially sound enough to decide what we want to do in our life, then obviously our confidence will be higher, as well as it provides a full financial damage coverage to the family members and assure them a financially secure future. So, these may be the various types of advantages that the persons or the insured may have from the insurance product. Now, next is the nature of the insurance. Now, understand what are the various characteristics of the insurance product. So, basically it is a risk sharing tool. That means it is a kind of mechanism that spreads the risk among a number of individuals who are willing to share the risk involved in each other's financial decision making or in each other's life. That means the risk can arise from events such as death, fire, marine accidents and other unforeseen incidents of the individual. So, all the individual, they come together, they raise a fund and they try to cover the damages that may occur due to these all risk involved into their life due to the different natural events. So, risk sharing is done here. It is a cooperative device, that means it works on the principles of cooperation. All the individual will agree to share the risk and they come for each other to support each other mutually and voluntarily, and they will establish a contractual agreement for the purpose of helping each other. So, evaluation of risk is done before offering the insurance product to the consumer. So, the level of risk is assessed in advance, and on the basis of the risk assessment, the consideration which is known as the premium payment in the insurance is determined by the insurer. So, if the risk is higher, the premium will also be higher, and if the risk will be lower, the premium paid by the insured will also be lower. Then payment upon occurrence, that means the insurance amount is paid. Insurance amount means the claim is paid by the insurer only upon the occurrence of the specific event mentioned in the insurance contract. For example, death in case of the life insurance. So, there may be the various types of occurrence of events, then only the damage cover will be done by the insured to the insurer in case of the insurance products. Now, let us understand the various advantages or benefits of insurance. If we talk about the benefits of the insurance product, it provides us safety, as we have talked about in the earlier slide also, that it offers us safety and protection against the uncertainties of our financial decision making as well as life. So, various uncertainties may include the death of the insurer in case of the life insurance, whereas in case of the general insurance, fire insurance may be there, marine insurance they may be there, that may involve different type of occurrence of risk. It eliminates the dependency, that means it reduces the financial dependency on others during the time of loss. If the person or the individuals are having the insurance policy with them, they need not to rely on others during the financial crisis or unexpected events. It also encourages the investment and saving habits among the investor. So, this benefit also helps in the mobilization of saving into the investment. So, it develops the habit of regular saving through the consistent premium payment by the insurer. Additionally, many of the insurance policies nowadays also provides the investment features. That means for the individuals who cannot directly invest into the financial market, these insurance scheme may also provide some insurance investment plan, and that can be a very good option for the investors and savers of money. The next benefit of the insurance products is to provide old age support. That means it serves as a financial pillar for all those investors who are attaining the old age or not having any protection against the uncertainties in the older ages such as health issues or medical expenses. So, it provides you a sense of security and stability in the age of your retirement also. So, these are the various benefits of the insurance products. Now, let us understand the various types of insurance schemes that we may have. So, the first type of insurance scheme is the life insurance scheme. It is a contract in which the insurer agrees to pay a specified sum of money either upon the death of the insured or at the end of the predetermined period, that means maturity period. Unlike the other forms of insurance, the life insurance contract is not a contract of indemnity. That means in case of the life insurance, the loss that is paid to the particular insured is not calculated on the basis of actual damage that may occur to the insured, because the life of the person cannot be compensated, only the financial damage can be covered. In fact, the life insurance is more accurately described as the assurance, the word that has been first coined for the purpose of giving insurance in terms of life of an individual was the insurance. That means regardless of the cause of death, the assured sum will be guaranteed to be paid to the legal heirs of the insured in case of the life insurance schemes. Now, some important terms that are associated with the life insurance schemes are: number one, policy holder. Policy holder is basically as a person who have bought the policy and pay the premium payment to the insurer company. Nominee, nominees are the person who are appointed by the policy holder who will receive the benefit of the policy in the case of the event of death or the maturity of the insurance policy. Then the next term is the premium. Premium is the basic amount, or you can say the contribution that is paid by the policy holder in exchange for providing financial damage cover to their life. Then comes the maturity period. Maturity period or maturity benefit is the amount of claim that is paid by the insurer on outliving the policy term to the insured. Life assured is the person who is covered under the policy. So, you can take a life insurance policy for your spouse, for your parents, for your child, and you can also become a policy holder, and life assured will be of the person for whom you have taken the life insurance policy. Then comes the policy term. It is the tenure for which the policy offers covers and benefits for the insured. Then comes the rider. These are the add-on benefits that can be added at a nominal increase in the amount of premium. in the case of the life insurance scheme, and then comes the death benefit, sum that is paid by the insurer at the time of the death of the policy holder is known as the death benefit. So, these are some basic terminologies that are associated with the life insurance schemes. Now, let us understand some of the principles that are related with the life insurance scheme. So, life insurance schemes are basically based on these principles. So, the first principle is the insurable interest. That means the person for whom you are taking the life insurance product, in that particular person's life your financial interest must be invested. If that person will be alive, you will be going to have financial benefits from them, and in case or in case of event of their death, the financial losses may be there for the dependent or the nominee in case of the insurance policy. So, financial loss may be there if the insured dies in case of the insurance scheme. This is known as the insurable interest. If there is no insurable interest, that means there is no financial interest involved in the life of the insured person. In such cases, the insurance policy cannot be created for them. But this insurable interest does not include any kind of emotional loss. That means financial interest must be invested in the life assured of the life insurance policy. Then comes the utmost good faith principle of the life insurance, that says that both the insurer as well as the insured will have to disclose each and every specification related with the contract terms and condition. So, any information that can affect the nature of contract must be disclosed by each of the party, so as to provide the real information, and the contract may be affected by all those information. So, that means if the information will not be disclosed, the contract in future may be invalid for the insured. Next is indemnity. So, the principle says that the insurance is done only for the coverage of the loss. That means you cannot make the profit out of the insurance contract only to the percentage of damage or the loss. The financial coverage will be provided by the insured to the insurer. There will be no case where you will be able to make any profit from the insurance contract. Now, the principle of contribution is there. Contribution principle says that whenever the insured takes more than one insurance policy for the same subject matter, then according to the principle of indemnity, the insured cannot make a profit by claiming the loss of one subject matter from different policies or from different companies. So, they can claim their losses from only one insurance policy, or if they are taking a double insurance policy, then also two of the different insurance policy will assess the loss, and the damage cover will be provided by both of them, but only to the percentage of the damage occurred to the insured. Then the last principle of insurance is the subrogation. Subrogation basically means stands in for another. That means after the, as per this principle, after the insured, that is the individual, has been compensated for the incurred loss to him or on the subject matter that was insured under the policy, the rights of ownership of that property goes to the insurer. That means the company who have insured the particular subject matter for the insured. So, these are the underlying principle of life insurance scheme. Now, let us understand what are the different factors that affects the life insurance scheme. So, basically age of the insured always affects or influence your insurance premium and the other terms and conditions of the insurance scheme. So, younger individuals basically they are considered as the lower risk, and that is why they need to pay lower amount of premium if they take a life insurance policy as compared to the other older individuals. Whereas gender is also a factor that affect the life insurance policy. The various studies and observations have shown that women tend to live longer as compared to the men, and because of this particular observation, the life risk associated with women is lower, and that often leads to lower premium for the female policy holders. Health and alignments are there. If your current health is okay and you are doing great, in such cases your premium will be lower. Whereas if you have multiple health issues or any chronic illness and your life expectancy is lower, then it will increase the risk of your life, and that is why your premium will be higher in case of the such kind of health issues. Then the family health history also becomes a factor for the life insurance. So insurer may ask you about your family's medical history to assess the likelihood of the hereditary or genetic condition, and if there is any serious illness in your family history, that can result in higher premiums for you. So these are the various factors that affects the premium payment in the life insurance policies. Now let us understand what are the tax criteria that you need to know before investing into the life insurance scheme. So according to the Income Tax Act 1961, the section 80C provides you that you can claim a deduction for a contribution of a maximum of 1,50,000 rupees for the payment of life insurance premium. Here you need to note that the tax deduction is applicable only if individual file their tax return as per their old tax regime. So who has not opted for the new tax regime under the section 115BAC of the Act, they can take the benefit of the 80C, and they can take a deduction of 1,50,000 by investing into the life insurance schemes. The maturity benefits are also exempted under section 10, subsection 10D of the Income Tax 1961, subject to certain condition, as well as death proceeds are completely exempted for the nominees of the life insurance policy. So these are the various tax criteria that you need to know about the life insurance policies before investing into the LIC schemes. Now let us understand the various types of life insurance scheme claims, how the insurer pay the claim to the different insured, that means the policy holder. So what are their different types of claims? So first one is the maturity claim. A maturity claim basically arises when the insurance policy reaches to the maturity time period of its term. That means if a life insurance policy has a duration of 4 years and the policy holder survives for the entire term, the maturity claim can be made at the end of the time period, and the insurer then pays out the maturity benefit to the policy holder in the form of maturity claim. The next type of the life insurance claim is known as the death claim. A death claim basically occurs when the insured person passes away and during the duration of the policy of the term. So before the policy reaches to their maturity, and if the insured is dead, in such cases the nominee or the beneficiary can file for the claim and they can receive the death benefit from the insurer. Then there is survival benefit claim. These claims are applicable under the money back policies of the life insurance scheme. A survival benefit is basically a portion of the sum assured that is paid out at a regular interval if the assured is alive at the time of each scheduled payout. So these payments serves as a money back benefit during the policy term for the insured. Now the next one is the term life insurance. Now let us understand what do we mean by the term life insurance. In case of the life insurance policy, there are two different types of policies that we need to know about. One is the term life insurance and the second one is known as the permanent life insurance. So let us understand first what do we mean by the term term life insurance, and then we will be going to discuss about the permanent life insurance scheme. Basically, term life insurance is the most convenient as well as the cost effective life insurance policy that is taken for a short period of time, say ranging from 3 months to 7 years of time period, and the sum payable is paid only at the time of the death of the life assured occurring during that period. That means if between the duration of the term of the life insurance scheme, if the insured will be dead, then only the insurance claim will be paid to their nominees or the benefit holders. That means the term life insurance provides the death claim to the nominee of the policy holder. So, for whom this particular term life insurance is suitable, let us understand. So, those who need any kind of extra protection. So, term life insurance may be ideal for all the individuals who require any additional financial protection for their specific financial objectives for a shorter period of time. So, suppose that if you have taken any house building loan and you need to repay an amount of 50 lakh rupees, but you do not may have a regular earnings with you, as well as you must be also having certain other kind of risk associated with your life, and you may have a variety of expenditures that you need to plan, such as your children's education, your repayment of loan, as well as your daily livelihood expenditures may also be needed to be paid. In such cases, to provide you with an extra layer of financial protection, you can take the term life insurance. So, in the case of event of your death, the term insurance scheme and the death benefit that your nominee will receive from the policy, that will help you to meet all the financial obligation that you may have in the present lifetime. Now, the individuals with the limited income, all those individuals who are having a very limited sources of income with them, that means they may not be having a good amount of earnings with them, they can also take the help of term life insurance. So, this is one of the most affordable forms of life insurance for all those who are having lower income for their livelihood. So, it offers them an essential protection which is offered on a low cost basis, and it can be good option for all those who need long term coverage for the risk management of their life. So, short term premiums are required in case of the term insurance by these insured persons. Now, the next category of the individuals are key person insurance, that means the key man insurance. So, in a business context, when we talk about the organizational concept or the entity concept, a key person is someone whose skills or whose knowledge may contribute to the company's success. So, whatever they are contributing to the company by providing their time, by providing their efforts, that may be very crucial for the success of the company. So, a keyman insurance policy is basically term insurance life insurance plan that provides financial protection to a business in case the key individual passes away. So, this type of schemes basically help the business to manage the financial impact and transition of the ownership or the management from one person to the another. Now, let us see the various features of the term life insurance, features and benefits. So, in case of term life insurance, high sum is assured at affordable premiums to the individual. So, you can take a term insurance policy of a very high sum assured, and for such kind of term insurance policy, you need to pay a very small amount of premium in case of the term insurance policies. It is a pure protection plan. So, in case of the event of your death, the financial protection will be provided to your dependent family members and the nominee of the policy. It provides coverage for a specific period of time. That means, suppose that if you have taken the term life insurance plan for 10 years only, then the coverage will be also provided to you for 10 years period only. And if you want to renew your policy, then again you need to renew your contract and you will have to pay some more premiums for getting coverage of the insurance for a longer period of time. After that, it aims at providing the death benefit to the insured. That means in case of event of the death only, the death claims will be paid to the nominee of the policy holder in case of the term life insurance. So, you can say it provides a sense of safety and security to the financially dependent person of the policy holder in case of the term life insurance. For example, suppose that if there is a person who wants to protect their family from the unlikely event of the early death, and he buys a 10 years 10 lakh rupees term insurance policy, then they need to pay a premium of rupees 100 per month. So, in case if they die within a time period of 10-year term, the policy will pay the beneficiary, that is the financially dependent nominee of the policy holder, a total sum of rupees 10 lakh. So, if he dies after the term of the policy and the policy has expired, then the beneficiary will receive no benefit for such life insurance term policy. So, if he remains alive and renews the policy after 10 years, the premium will be higher, and then again they will need to pay the premium, and it will be again evaluated on the basis of the current age and health specification of the individual. So, this is how the term life insurance can save the financial interest of the policy holder. Now, let us understand the difference between the term life insurance as well as the permanent life insurance scheme. The main difference between the term life insurance policy and the permanent life insurance policy may be depending on the different criteria such as duration of the policies, accumulation of the cash value, and the cost involved into the life insurance scheme. So, every investor who is having different type of objectives to fulfill, such as some may have the objective of accumulation of cash value, or some may need only the life insurance, and for a particular duration of time they need to financially protect their family. Different type of life insurance policies can be chosen. So, permanent life insurance policies basically aim at providing you an insurance scheme for whole lifetime of your life cycle. So, the amount of cost invested into the permanent life insurance schemes are higher as compared to the term life insurance. Now, let us understand the various key features of the term insurance. Here basically the death benefit is provided. Premium payment options are varied, so it suits to different type of investor. You can choose any type of premium payment scheme such as annual, semi-annual, quarterly or monthly premium can be paid. Policy terms and conditions may be different for the different kind of products also. So, for the duration for which you are taking the insurance plan, and on the basis of some other terms and conditions and your financial objective, the terms and conditions of the policy may be different for different investor. So, what are the various eligibilities that you must have to take the term life insurance? So, in the normal cases, the age of the policy holder must be from the 18 years to maximum of 65 years. However, in certain cases there may be some kind of exceptions. So, this may vary according to the policies of insurer. They may charge a higher amount of interest, and they can also provide the term insurance plan to the individuals who are older than the 65 years of age. It may depend on the policy of the insurer also. Then comes the sum assured. The sum assured in the case of the term life insurance policy is the coverage amount that is provided by the term insurance policy to the beneficiary of the policy holder. So, insurance company may have a minimum or maximum limit for the sum assured depending on the terms and conditions of the contract. So, the maximum sum assured may depend on the applicant's income, their age and overall financial profile. Then occupation is there. Occupations means you must have some regular source of earnings with you. So certain occupations that may involve higher risk, that means there may be different kind of professions such as mining and aviation and armed forces, where you need to face much challenges and risk as compared to the other professions. So here you need to pay a little higher premium as compared to the other type of professions that we may have in our life. Now these are the different type of eligibility criteria that the insured must fulfill for the purpose of taking term life insurance policy. Now in our next lecture we will be also going to understand some of the other insurance plans that can help you to manage the risk as well as invest your money into the insurance schemes in a well planned manner. Now I will conclude my lecture. Thank you.